Hello everyone, and welcome to this presentation of risk-reward ratio done right. Now, risk-reward is something that the majority of traders use in their trading, whether they're day trading, overnight trading, or investing. But we feel that most traders are using it incorrectly, and many times you're putting such strict rules on your risk-reward ratios that it will have you stop trading a fairly good strategy. So we're going to show you how to do it right so that you can apply it to virtually any strategy, any method, in any time frame, in any direction, and it can fit just about anything. So this promises to be a great presentation. You're going to learn a lot, and I want to welcome you once again. My name is Primo. I am the president and founder of Specialist Trading. If you're new to my presentations, we are all about educating you as traders. You see, it's our belief at Specialist Trading that the reason why most traders fail is basically because they're taking themselves out of the game. They're relying on someone or something else to tell them exactly how to trade. I mean, just think of it. Look at your own trading. Do you make your decisions based off of a chat room or a trading room or some fantastic system that you just purchased or what someone is saying on TV or the earnings reports that are supposed to come out? Basically, this is the way 99.9% of all traders trade. And it's my opinion the reason why most traders fail. Now, I say this from firsthand experience because this is the way I used to trade myself when I first started. I've been trading for 40 years now. I started my career on the floor of the Pacific Stock Exchange. I was on the floor for a total of 16 years, and 9 of those years I was a specialist. That's where we get the name specialist trading. A specialist was simply someone that made markets and stocks. So if you wanted to buy or sell a particular equity, you called up your broker. The broker would contact the floor trader, and the floor trader would go up to the person who specialized in that stock. And that's what I did. I made markets during the crash of 1987 and the bull market that followed. I've traded in just about every market environment imaginable. I've traded every system or strategy you can think of, so I know what works in terms of consistency and I know what doesn't. About 8 years ago, I teamed up with Pro Trader Strategies and we formulated Specialist Trading, where all we do is teach and mentor our students in over 110 countries around the world and in virtually every state in the United States, all of the tips and techniques and strategies I've accumulated in my 4 decades of trading. And these are things that I use in my current trading as well. So as you can see, we're all about educating you so you can put the power back in your hands and make your own trading decisions. This is our philosophy of how you will ultimately become a consistent trader, by making your own decisions. So we just want to educate you with things that have shown consistency through the years. I'm going to share with you some great techniques for adding consistency using risk reward. But before we begin, we are required to show you this, so please take a moment to view our disclaimer. I'm going to show you a lot of performance results using this particular method of risk-reward ratio, but please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated in the future. So once again, we are required to show you this, so as you're taking a brief moment to view the disclaimer, I would also like to take this time to invite each and every one of you to follow us on Twitter. In fact, you may want to copy down our handle right there, the abbreviation for Specialist Trading. I post different information each and every day, anywhere from little bits of wisdom, trading wisdom along the way, to actual signals that our strategies have generated. So there's a lot of great free information available on a daily basis. Okay, so as I stated earlier, we are all about educating you. As you can see here, my goal is not to force feed you signals. My goal is not to tell you what the perfect time frame is. It's not to tell you the perfect market to trade. We don't believe in that. We just simply want to teach you how to trade with the specialist edge. I've made no secret about this. When I first started trading some 40 years ago, I struggled tremendously. I had a very difficult time, and I was even on the floor. So it was very difficult to really figure out how to do things, even with all the advanced information I was getting. I was following all traditional wisdom and doing all the things I had gone to the seminars and read the books, but nothing was working in terms of consistency. Sure, I'd have a couple of winners every once in a while, but then I'd give it all back. So I was lucky enough to have some mentors who really changed my way of trading. They shared with me all these things and told me what I should be focusing on and what I should simply be letting go and discarding. And it's because of that that I feel these things that they taught me have been able to sustain me for 4 decades now. So this is what I do. I teach and mentor my students the same things that turn my trading around, and hopefully they'll be able to turn your trading around as well. So once again, we are strictly educational. Our goal is to teach you how to trade with the specialist edge, the same edge that was able to turn my trading around some 40 years ago. All right, now since this is an educational presentation, we're going to conduct it as if we're in a classroom. I will take the questions that you have concerning everything I'm presenting today, but please wait till the end of today's class, probably in about the next 20-25 minutes from now. If we stop every couple of minutes to answer and ask a question, this half-hour presentation will turn into a 5-hour presentation. So I like to keep things moving and reserve the last 10 or 15 minutes for any questions you may have. So if you joined us late, please ask the questions at the end. And the only question I will answer is the most common and popular one, and that is this being recorded? Yes, it is. We record all of our webinars. So if you have to leave early, or if you're having trouble viewing the presentation and technical difficulties, please request a copy of the link of this recording from Pro Trader Strategies, and they will send everything to you. Okay, so let's begin. Here's what you're going to be learning today in today's class. We're going to start off by sharing with you what an acceptable risk-reward ratio is, for those of you who aren't familiar. And then we're going to share with you what a low risk-reward ratio is, what a lot of traders trade with. But simply because you have a low risk-reward ratio does not mean you have to discard the strategy or stop trading that. It's still okay if you apply a couple of edges. And these are the edges we're going to reveal today. The first edge is going to show you how to increase your risk-reward ratio based off your entry. And the second edge is going to teach you how to increase the risk-reward based off of your exit. Okay? So let's begin, and let's start off with a standard definition of risk-reward for those of you who aren't familiar. Risk-reward is simply a ratio used to compare the expected returns of an investment to the amount of risk undertaken to capture these rewards. All right? Now, I know it's kind of wordy. It may have thoroughly confused everyone by now, but if we want to put it into a formula, reward is simply where you purchase something and where you expect to exit with a profit. That's called your reward. So the opposite side of the coin would be risk. Risk is where you purchase something and where you would get out if you had a loss. That's your risk. So what you want to do is divide the reward, how much profit you hope to make, divided by the risk, how much you expect to lose if you're wrong, and that will give you the ratio. Okay, so it's really that simple. So let's look at a risk-reward example. All right, this is hypothetical, but let's just say you purchased 100 shares of XYZ Corp. And remember, we're using stocks here, but it can virtually apply to anything. It doesn't matter if it's stocks, futures, currency pairs, it makes no difference. But let's say you purchased 100 shares of fictional XYZ Corp at 20. And you placed a stop loss order at 15. Now you placed a mental stop loss. Let's just say you knew that once that price got to 15, you're going to exit. All right. Now, if you're stopped out, in other words, with a loss, you will risk 5 points. Okay. So if we look at a chart here, fictional chart of XYZ Corp, here's where your entry was, right here, 20. And you're going to have some type of mental or physical stop here at 15. So from here to here is basically a risk of 5 points. That's your risk. And that should really be the first thing you always define, how much you're willing to lose. Okay? Now, let's also assume that you believe the price of XYZ will reach 30 in the following months. Okay? You've done the analysis, you've read about the company, you've looked at the earnings, whatever you like to follow. Now, in this case, you are willing to risk 5 points in order to make an expected return of 10. So as we look at the chart once again, you purchased at 20. If you're wrong, you're going to get stopped out at 15. You're going to lose 5 points. But if you're right, you're going to exit up here for a 10-point gain. Now, since you stand to make double the amount you've risked, this trade would be said to have a 1-to-2 risk-reward ratio. All right? If 1 would equal 5 points, 2 is double that amount, 10 points. So you're risking 5 to make 10. Okay, so as we look at the chart once again, here's where your discretionary exit would be based off your analysis and where you think it should go. And ultimately, you exited at 30. So the risk-reward ratio is 1-to-2. Not bad. You had a good trade there based off whatever strategy or method or system you're following. Maybe it could be just something, a hunch on your own. But that was okay. You said if you lost, you'd lose only 5, and if you made money, you'd make 10. If you keep doing this with this traditional risk-reward, okay, well, you're going to do fine because, you know, over time, if you lose every once in a while, you could lose a couple of trades, but basically only have to make one winning trade to break even, or I should say make everything back that you just lost. Now, that's just a standard textbook traditional example. But what if you trade a strategy or a system with a fixed exit? Because what we just shared with right now is purely discretionary. In other words, you decided and defined on your own where you're going to get in, where you're going to get out, and where you want to get out with that profit as well. But what if you trade a system? What if you trade a strategy that comes with all these predefined points, predetermined, and you have an exit that's also predetermined? That's called a fixed exit because it's fixed where you're going to get out, and you know you're going to be getting out prior to even entering sometimes. So let's look at another example here, and this is actually based off one of our strategies. Here's an older chart of Apple on a weekly time frame, and this is one of our strategies that generated a buy signal. I believe this is strategy number 4. Now we call this the setup bar because on this day here, circled in blue, the setup came to fruition. In other words, all the requirements of the strategy were met. So basically, this is telling us once everything is met on this day, we can enter into the trade. So we would have entered on the opening of the next day at 113, okay? And we placed our stop just below that setup bar where all the rules came to place, just below there at 105, okay? So we're risking 8 points. Now, according to this strategy, our predefined exit, our fixed exit is at 121. Well, guess what? In 3 or 4 weeks, we got there. And so we had a nice trade where we made 8 points. Not bad. That's a pretty good trade. But someone looking at this strategy or doing their research on this, looking at past trades, would have said, that's really not a good strategy, Steve, because look at the risk-reward ratio. You risked 8 to make 8. That equals a 1-to-1 risk-reward ratio. Now, in standard conventional wisdom, that's not a very good. And ultimately, you'll either break even or lose a little bit of money using a strategy or a system that has a 1-to-1 risk-reward ratio. So it's really not acceptable. So many people already know this. I'm sure the majority of you know this already. 1-to-1 is not, a very enviable risk-reward ratio. So if you have a strategy that basically works off of 1-to-1 and has good results, most people would throw that away, or they'd say, no, I'm not going to purchase that, or no, I'm not going to get involved in that because, over time I won't make any money. How can we alter that? Okay, how can we keep that strategy and not have to throw it away? Maybe it is a very good strategy, but how can we continue to trade it? Well, here's edge number 1. Here's what I'm going to be teaching you today. You can control the risk-reward ratio of any trade by simply altering its entry point. Okay, so it's that simple. You don't have to discard the strategy because over time, the risk-reward is 1-to-1 or even worse than that. Let me show you what I mean here. What's important to look at is the setup bar. Okay, the setup bar is in virtually every strategy, every method. It doesn't matter if it's based off of fundamental news. It doesn't matter if it's based off indicators. It doesn't matter if it's based off the tides of the ocean. But when all the requirements are met, when all the rules are met, that usually happens on a certain bar, whether it's a 5-minute bar or a monthly bar. That's called the setup or the signal bar. That's where everything comes together and you're given the green light to either buy or sell, regardless of what market or what time frame. That's our setup or signal bar. Now in this case, on our particular strategy, it was right here. So the signal bar is all important. Remember, it doesn't matter what strategy it is, and it doesn't matter what time frame. This could be a tick bar chart. It wouldn't matter. But what you want to do is measure the range of the setup bar where all the requirements were met, where all the rules came into play, and you got the green light to buy or sell. Okay? You measure from top to bottom. Now, this is a standard open, high, low, close bar, but it makes no difference if this was a candle bar or a range bar. It makes absolutely no difference. You're just going to take the extreme high or the top of the wick to the extreme low or the bottom of the wick. And that's the range. The range is not open to close. That's the range of the body. We're talking about the total range from top to bottom. And what you want to do is on that setup bar, divide it by 4 separate but equal divisions. So, down a quarter, down 50%, down 75, and then 100%. Now, normally, once all the rules came into play, you would simply buy at the market or buy in the opening of the next day. Here's what we're going to do. We measure the range of this and we divide by 4 separate equal parts. And then the first entry point is down 25%. So we're not going to simply buy at the market when we get the green light that all the rules have been met. We're going to place a limit order down 25% or down a quarter from the top, okay, since we're buying. So now what we've done is we've lowered our entry from 113 down to 110, okay? And now if we buy at 110, we're keeping our stop the exact same place. We're keeping our exit the exact same place. Nothing changes. Remember, this is only editing and altering the entry point. So we've entered now, instead of 113, we've entered down 3 points down to 110. And if we get stopped out, we'll get stopped out at 105. So now we've decreased our risk by 3 points. We're only risking 5. But guess what? Now we made 11 points. So we basically risk 5 to make 11. So we have, for all intents and purposes, a 1-to-2 risk-reward ratio. Acceptable risk-reward. There you go. Okay? You just altered where you were going to enter. Now, I know a lot of people know this and they say, oh yeah, sure, I've tried that, Steve. I just, I'll wait for it to go down a little bit, then I'll enter. But you see, there's no structure. There's no discipline. There's no real, type of order to that. Mostly when people do something like that, it's just based off a hunch. Like, well, okay, I think it's gone down far enough, I'll get in. But here for the first time, you have some actual structure on where to enter. And it's based off of that setup bar. So you're simply dividing that setup bar by 4 separate but equal parts, and you're going to enter down a quarter. Now let's say you'd like to get a better risk-reward ratio than 1-to-2. All right. Well, then you go down to the next level, which would be 50%. And instead of placing a limit order there, you would place a limit order at 108. Okay. The stop stays the same. So now you're only risking 3 points. Your exit point stays the same, and now you've made 13. So you've risked 3 to make 13. And basically, you have now a 1-to-4 risk-reward ratio. Much more acceptable, okay? But we're not going to stop there. We're also going to give you one more entry point. Remember, we divided the setup bar by 4. We're going to go down one more level, down 25%, down to the 75% level. And now we're going to enter a limit order to buy at 106, which we would have gone long the next day, okay? And we only risked 1 point because our risk stays the same. Our stop stays the same at 105. So we risked 1 point to make 15. Our risk-reward ratio is now 1-to-15. Sound like a very good risk-reward ratio? Sure does. So do you see, we kept the same strategy. The same green light was generated for us to go long. We just altered our entry point. But it's not a discretionary, subjective way to enter. This is the way most people will use this. They'll say, well, I'm going to buy it a little bit lower, and they have no idea where they're going to buy it. It's just based off a whim. They're watching the market. But now you have structure. You know exactly where to enter. 3 separate but distinct points based off of 25% levels in the setup bar. Okay? Remember, this is all based off of the range of the setup bar. Now, a couple of things to remember. If you decide to purchase at the 25% level, that's where you will be filled most often, okay? Because oftentimes you'll see the price go down to that level and then start to go up, okay? The mean level will be at 50%. You won't be included in trades as much as you would for 25, but at least you'll have a little better risk-reward ratio, and you will be purchasing it lower, but you won't be in as many trades. Now, lastly, at the 75% level, you'll be in the least amount of trades because oftentimes it will not get down to that level and you'll see price take off. But this will give you the least amount of exposure, the least amount of risk. So for everything, there's a balance, The brighter the sunshine, the darker the shadow. So the best, risk-reward ratios will be off 75%, but obviously you'll have less trades there. So it's up to you. Experiment with these different levels to see which works best and what you feel most comfortable with. I'll show you some more examples here. Let's look at a way to go short, because you can apply this going long or short. It makes no difference. Here's an example to go short TGT. All right. Now, the standard rules of this strategy, once again, this is one of ours, would say, well, you would go short here right below the setup bar. Here's the setup bar right here. You would enter short 82.75, and you would have your stop at 84.25. Okay. Now, here is the fixed exit at 81.75. So these are all the standard benchmark rules to this particular strategy. And as you can see, in 3 days, you made a full point. You entered at 82.75, you exited at 81.75. But guess what? You were risking 1.5 points just to make 1 point. Sound like a good risk-reward ratio? Absolutely not. You're risking more than what you wanted to make. Does this mean this is a bad strategy? Absolutely not. It just means that the risk-reward ratio does not meet your needs, so you may have to alter things a little bit. Remember, this is why we say this is the way you become a consistent, successful trader, by taking charge of your trading. This is what we do. We provide you with all this information so that you can make these decisions. Okay? You don't just happily say, well, I'm trading this system. I don't know what it's based off of, but I just enter the orders when they tell me to buy and sell when they tell me to sell. That's no different from someone, a brain surgeon saying, well, I just don't know what to do here. I just kind of wait till I open up the patient. And I just kind of wait and say, well, I wait for someone to tell me what to do. You have to be in charge. It's no different when you're trading. You can't just wait for someone to tell you, instruct you. That's a recipe, once again, for a disaster. So you do not have to throw away this strategy. We simply take the measurements of the setup bar. That's from top to bottom. And if this were a candlestick chart, it would be the top of the wick to the bottom of the wick. We divide by 4 separate equal parts. And once all of the requirements are met, instead of going short on the next bar, what we do is we go up 25%. And now we'd sell at 83 1/4. We'd leave our stop at the same place, which is 84 1/4. So we'd risk 1 point and exit at the same place, and we make 1.5 points. Okay, so we just reverse the risk reward. We now only risk 1 to make 1.5. Still not acceptable though. The standard benchmark for risk reward is 1 to 2. So let's go down to the half level at 50% right here. Okay, and you can decide all this before you even enter the trade. This is the beauty of this. So now we're selling at 83 1/2. Our stop is still at 84 1/4, so we're risking basically 75 cents to make $1.75. Not bad. Now that's more acceptable. It's basically a 1 to 2 risk reward. So you could take that, and if you really wanted to go for more, you could take the 75% level because you would have gotten filled there as well. And you would have risked a half point because you would have gone short at 83.75 to make 2 points. So you're risking 50 cents to make 2 points. That's a 1 to 4 risk reward ratio. So now you've made it acceptable. Did you change anything? The only thing we change is where we entered. That's it. Now, I know once again, this is very simple and it's very, probably very common, but we've now given you structure because I can almost guarantee that the majority of you, if you've tried this before, you say, well, I'll buy it down a point or I'll, offer it up a point higher than where I usually get in. That's just off a whim. That's discretionary. Remember, we don't want to keep things discretionary like this. We want to have some structure to our trading. Now, from time to time, you'll see something like this. Here was, I think, was an actual example of one of our students. Here was a weekly chart of the diamonds. That's the ETF for the Dow Jones Industrial. Now, here was an actual signal to go long. This would have generated an entry right here at this point. Your stop is supposed to be right here, and your exit would have been right here. But you can see that you're risking a lot more than the standard benchmark exit. So what we taught our students was the same thing based off of the setup bar, which was this bar right here. You could either enter down 25%, down 50%, or down 75%. You would have gotten filled at each one on this weekly basis, and you would have had a nice profit. And look, it got right up there. You had a really nice risk-reward ratio had you entered at down 50 or down 75. And right when it got there, it started to go lower. Now, this is what happens many times with our students. So they say, Steve, I love this. This has really helped me because before when I thought I couldn't take the trade, now I actually still can. I just alter my entry point based off of this this formula here. But this happens a lot. And I'll say, what? They'll say, well, many times I'll get out with a nice, 1 to 2, 1 to 4 risk reward ratio. And I exit the trade just like this, and then this happens. And you leave a lot of money on the table. I'm sure you've all gone through that. You've exited a trade and you say, boy, that was nice. I made some quick money. I feel really good. And weeks later, you're saying, why did I get out? Boy, I just left so much money on the table. I could have been rich. Okay? Well, this brings us to edge number 2. You can also control the risk-reward ratio of any trade by altering its exit point. So this is another edge. It's another way to determine your risk-reward. So the way we do it is by adding a proprietary tool we have only at Specialist Trading and Pro Trader Strategies. It's called the PET-D. This was a tool introduced to me some 40 years ago, and I've been using it on nearly a daily basis for the last 4 decades in my own personal trading. It is the best thing I know of for determining the short-term trend. Now, when I first learned about this from my mentor some 40 years ago, we had to figure this out by hand. Because as traders on the floor, we were basically trading 5-minute, 10-minute charts, and we were in and out of trades very quickly. And in order to know what the next bar was going to be according to this trend identifier, we had to, only apply this to daily bars because we couldn't be doing this every 5 minutes. It would just be too cumbersome. So what we did was we generated this and developed this into a color bar algorithm. So now when you see a series of green bars, it's telling you that the short-term trend is up. There's nothing to figure out. There's no formula to figure out. There's no calculation. It's all done automatically for you on our platform. When you see a series of red bars, automatically telling you that the short-term trend is down. It's that simple. So let me show you how we can apply it for different instances for keeping you in the trade longer. Here's another example of one of our strategies. It was a buy setup. Let's say you're trading the standard benchmark. You most likely would have exited here, okay? Made a nice quick trade in a couple of days off that big gap. But what if you thought this market was going much higher? What if you thought, boy, this is the beginning of a strong move? So what we advise our students is to sell half their position, even if it's only 50 shares, sell half of it at the standard benchmark and let the rest run. But how do you let the rest run? By simply applying the PET D, because the PET D will tell you what the trend is. Let's apply the PET D to this chart in KSS, and now we see that the majority of the bars are green. In fact, it confirmed the buy signal. Even when you exited here, the bars continue to be green. So what we want to do is we want to stay in this trade no matter what, even if the bars start to come down. But as long as the bars are colored green, we do not want to exit. So let's follow this trade, and we can see we had a couple of down days. Now, this is where most people get scared and say, well, boy, I think, these institutions that follow this are starting to exit now and take profits. Plus, we've reached some major, major resistance. And the chat room I go to says that we're in the tremendously overbought territory. So you've got to exit here, okay? You see, once again, this is the way how most traders trade. You listen to someone or something telling you what you should be doing. We at Specialist Trading and Pro Trader Strategies only listen to one thing. That's the chart in front of us. That's the market. We don't require any of our students to look at news. We don't require any of our students to look at earnings or tons of indicators. We keep things as simple as possible. And one of the simplest things is just by looking at this color algorithm, because what the PET D does is it doesn't predict anything. All it does is simply translate what the market wants to do on a bar-by-bar basis. So as long as the bars are green, we're still staying in the trade. So let's follow along. You see how it wouldn't have been a good idea to exit, because look what happened. We immediately went back up. All the people that said this was major resistance, all the hedge funds that were selling, all the chat rooms that were telling you you're now in the overbought territory, it's silly. The market is telling you it wants to go higher because the bars are green. So don't get fooled. And they continue to stay green. Now here we're starting to roll over again. You're starting to get scared, but are the bars changing color? Absolutely not. So you stay in the trade and look what happens. You see, this is why most people exit too early, because they get scared. They listen to someone on TV. They listen to some news report, and they scare themselves out of it. You should only be listening to one thing, and that's the market. So the bars are still green until we get to here. This is our first red bar. So you have an option. You can either sell everything at the market and say, boy, thank you. That was a really nice run, and you kept me in this for a couple of months. Or you can place a stop just below. But either way, it's up to you. You're protecting yourself now. You can place a stop wherever you want, down one tick, down a half point, a couple points. It's up to you. And if you place a stop, it would be just below that red bar, and look what happened. So you see how the PET D determined that the trend was changing well in advance, and it kept you in. So this is a great way to increase your risk-reward ratio by keeping you in those long, big runners. Let's look at another example. Here's another, I believe this is strategy number 1 in HCN. This is one of our most consistent pullback strategies. And this generated a sell signal in HCN. We pulled back, and where most people may have thought we made a double bottom here or some support, we were generating a sell signal. It worked out very well. Let's say you took the standard benchmark and you went short, and then you covered, let's say, half your position here. Let's let the rest run by using the PET D. So let's apply the PET D, and we can see now that the setup bar was red, telling us it's okay to short, and the remaining bars continue to be red until here. Here is our first green bar. Now, once again, you always have the option to exit at the market if you like, but we say be a little bit more conservative and just place a stop above that, because many times this will happen. You'll get a one green bar, and then it's right back lower again. So now when you get the next green bar, well, you place a stop above that one. So you lower this down here, and look what happens, okay? So you continue to follow this process until ultimately you're stopped out. So you see how the pet D has kept you in. You exited and covered half your positions here, and you're still in the trade short until you're ultimately stopped out by having a stop go above the last green bar. Now remember, this can work on any market, any time frame. Here's a 5-minute chart of the E-mini S&P. Okay, here's a buy signal, strategy number 4, buy signal. Let's say we had entered this, you most likely would have sold half your position around this level. But what if you wanted to stay in longer? Well, let's apply the pet D, and all the bars are green, except for this. Here's the first red bar. So you place your stop there, and you see how the pet D would have kept us out of trouble. Because this is what most people do. If they decide to stay in using, some type of method, parabolic or something, many times they'll stay in the trade way too long, and they'll give back a lot of their profits. So as I stated earlier, the pet D is the best tool I know of for defining the short-term trend. Now here's a range bar of the E-mini futures, okay? This is a 3-point range bar. Here was an actual sell signal using one of our strategies to go short. If you had taken this strategy, short signal, you most likely would have covered somewhere around this level. But what if you wanted to stay in the strategy longer? You just simply apply the pet D. And once you entered in the trade, you want all the bars to remain red. And they did. Here's our first green bar. You place your stop there, and you continue to hold on until the end of the day. You could have stayed short going into the next day or covered. Lastly, let's look at the euro-yen. Same concept applies. We went long here. Sell half your position, roughly about the standard benchmark exit, and let the rest run. You would have exited the remainder portion right here. So it doesn't make a difference what time frame we're looking at. It makes no difference what market we're looking at. It makes no difference what direction we're trading. The pet D is, once again, a great tool for just translating what the market wants to do. Here's a weekly chart of the Australian dollar. Let's go into a longer time frame. We have a red bar confirming the sell signal, the setup bar, so we go short, get out of half our position roughly around this area, and then place our stop above the first green bar, and that's where the trend changes and we start to go higher. Now let's review before we go into the question and answer portion. I tell you about a great offer we have for all of our attendees today. Remember, edge number 1, you can control the risk-reward ratio of any trade simply by altering its entry point. If you are in the market for looking for a strategy and you're doing your research, your due diligence, and looking at the past trades or some system, and you say, boy, it has a lot of winners, but the risk-reward is terrible. Well, you can simply alter it by changing your entry point. Remember, you have to know where the signal or the setup bar is. That is the bar where all the rules come into play. Let's say the strategy or system you trade is based off news. All right, when the news comes to play, or let's say the earnings came out at the end of the day, and that generated a buy signal for you because it was based off your numbers, off your analysis, and that's a very good number, so you want to be buying, right? Well, you're not going to buy at the opening of the next day. You want to alter the entry point by using this formula I shared with you. So if this was the day that you decided to buy, you're going to place an order down 25%, or place an order down 50%, or ultimately place an order down 75%. Remember, you'll get filled the most at this level. You'll get filled moderately at this level, and you'll get filled the least at this level. But this will have the least risk, this will have moderate risk, and this will have more risk, but at least not as much as the standard, okay? So it's all based off of structure. Now, edge number 2, you can control the risk-reward ratio of any trade by altering its exit point. All right, so you want to let trades run as much as possible if you really feel you've got a winner. What we suggest is to exit half your position at the standard exit and then let the rest run, okay? You don't want to just say that you automatically assume it's going to be a big winner and make 20 points because we don't know that. It may just go up, you'd hate to have it go up to your standard exit, your fixed exit, and then turn right around and you said, boy, I didn't sell anything and I missed at least that first exit. So we always suggest to our members, sell a portion at the fixed exit, move your stop to unchanged, and let the rest run. The only trouble is most people don't know how to let the rest run. Well, the pet D is the best thing we know of. Remember, it is not a predictive tool. It's not telling you how high something will go. It's not telling you how low something will go. It's not telling you how long the trend will be. It's simply translating what the market wants to do on that tick-by-tick basis. Green bars are simply telling you the short-term trend is up. Series of red bars equals a short-term downtrend. So before we close and take questions, I want to talk about our special attendee discount and our offer for all of the people in attendance today. This is a great, great offer we have. About 5 years ago, I was asked to be the head speaker at a conference in Denver, Colorado. I spoke in front of a large group at the conference, and I spoke for 3 hours. And during my presentation, I talked about many more high probability edges and educational tools to excel your trading and expand your trading to the next level. I talked about more high probability trading edges. I said which indicators you should be using and which ones you shouldn't be using. I talked about the difference between a system versus a strategy. I shared with the audience what I feel is the #1 chart pattern you should be looking for in every system or every strategy. But the most important part of this 3-hour conference that I spoke at was I gave the complete rules to one of our most consistent pullback strategies, and that's strategy #1. In fact, let me share with you a couple of examples. Here's an example in HAL. As you can see, this stock here was taking off, and then all of a sudden it fell out of bed. Now, someone could say, well, boy, Steve here, we broke this support, and this is where, this major Fibonacci support, we broke all that, so that's a real bad sign, and the volume really didn't confirm anything, so boy, I wouldn't touch this stock. This really looks like it's going lower. Well, not according to strategy #1, because according to the simple rules of strategy #1, it was basically saying the overall trend is still up, and this is just simply a pullback. So it generated a buy signal here, and look what the stock did in the following 2 to 3 weeks. Same thing happens to the downside, PBI, as we can see here. A lot of people would say, boy, this is a really nice base we're making. The institutions have all purchased here. This is some major support. It's being confirmed by all the indicators. I'm going to buy this, and if we come down here, I'm going to buy some more, okay? Well, not according to strategy #1, because strategy #1, according to its rules, said that this is overall downtrend, and that this is simply a pullback in an overall downtrend, and you should be selling. So it generated a sell signal on this day, and look what happened the very next day. Okay, so I gave all of the complete rules in this 3-hour presentation. Here's the good news. The conference recorded it for us, and so we have that video link, and here's what we're offering. We're offering that, all of the 3 hours, to all of the attendees today. All right, this is our Secrets of a Stock Exchange Specialist training sessions. It's 3 hours of trading techniques plus all of the complete rules: entries, exits, stop placements, how to trade it conservatively, how to trade it aggressively. This is the full strategy, strategy #1. But we're not stopping there. We're going to throw in some more information, because actually I'm very excited to announce we have just developed, Pro Trader Strategies and myself, we've just developed our first educational platform. It's PTS Primo Charts. As you can see here, this is our platform, and it's a great educational tool because it virtually has all of our strategies and all of our methods right there. Basically one-stop shopping. All you have to do is come here. As you can see on this green line, these are all the tabs to all of our methods. Okay, you see the PET-D is right here, and here's strategy #1. Now, if you're a member of the PTS Primo charts, all you'd have to do is simply load the chart of whatever stock, whatever currency pair or future you're looking at, and click on strategy #1. Okay. Now, automatically, we're looking at this chart in Facebook right here. We will be generating a buy signal. A buy signal was generated on the 12th of April. And look what happened in the following week. Stock went up around 5 points, okay? Now, here's another easy way to apply this. This is the simplicity of using all of our methods, because we're not just, once again, giving you a system. We have taught you in the course what you're looking for. This is just a way to check your work. Once you understand what to look for, strategy #1, you'll know when a signal has been generated just off your education alone. So we're not telling you what to buy or sell. This is an educational way to check your work. You punched up Urban, all you have to do was click on strategy #1, and you would have seen that on the 30th, just about 3 weeks ago, a sell signal was generated. And look what happened in the next 3 or 4 days, down about 3 or 4 points real quickly there. So this is a great educational platform for learning our strategies. You'll know the rules, you know what to look for. It automatically generates the buy and sell signals. As you can see here, we also have the PET-D. You would simply click that on and would color all the bars green or red. Here's the great discount we're offering today. We're offering you all this information, 3 hours of video, all these different high probability trading edges in our 3-hour video, along with 1 month of the PTS Primo platform. Now remember, this usually would cost you close to $1,000. we're offering this discount price at only $37, and that includes 1 free month of the PTS Primo charts. I can't think of a better way to get back on board with your trading. You have that 3-hour video seminar for life, and you'll also get 1 free month of PTS Primo charts. So it's a great way to get started. It's a great way to have me as your personal mentor, because one last thing I forgot about, you also have mentoring correspondence with myself. You will get access to my personal email, and you can contact me anytime you like with any questions that you may have. So $37. How many of you spent more than that today just trading? For $37, you're going to get 40 years of education in a 3-hour video. You're also going to get 1 month of our new PTS Primo chart educational trading platform. I can't think of a better deal, and we're so excited about this because we just basically developed this past year and came live this last couple of weeks. So here's how to be one of the first ones to become members of all this. Contact my sister site, which is Pro Trader Strategies. You can email them at trading@protraderstrategies.com. Probably the best thing to do would be simply to call them directly at area code 310-598-6677 for any questions. And then lastly, here's the link, the sign-up link to go to that great offer we have. Okay, now this link you see right here at the bottom is not live. You have to click that on. But if you look at the chat box on the far right-hand corner of the Go to Webinar column, under the chat box column, they have posted a live link. So you can copy that or just simply click that on, and it will take you to the $37 sign-up page. Remember, this is just for a limited time. You're getting $1,000 worth of education, a 3-hour video seminar for only $37, plus you're getting 1 free month included in that of the PTS Primo charts, where you can click on strategy number 1 and it gives you all the signals, okay? And lastly, you're getting mentoring experience via myself through my personal email. So I'm going to leave this information. You don't want to pass on this deal, $37 once again. I think most of you probably spent more than that today just in commission costs alone. Now, thanks for waiting. We still have about 15 minutes left. I'm going to answer any question you may have, so I'm going to open up the question and answer box. And once again, thank you so much for waiting. Let's see. The first question says, I base my trades from the charts. It's the risk I take, and this bad habit is going to ruin me. Yes, your risk is, once again, risk is basically something that people don't take into consideration, and most times people are risking far too much, either too much per individual trade or too much for their capital size. But we help you with that in our courses. In fact, we have an entire course dedicated to money management. It's our secrets course, a separate course altogether. So contact Pro Trader Strategies if you'd like to learn more about that. Okay. Let's see here. Let's see. Carol said, you'll never learn if you take trades from another without first checking the trade yourself. Well, yes, but our whole philosophy is that you should only be taking education from someone. Ultimately, you should be making all your own trading decisions. You don't want to be basing them off someone or something else. It wouldn't even matter if they were correct, because everyone brings something different to the table. All right? That person who has maybe 70, 80% winning trades who you're trying to copy, maybe their trading style is a little bit different. Maybe they're willing to trade 20 trades a day that get them up to that level. And you don't like to trade that much. Maybe you only want to trade 1 trade a day at the most, maybe 1 or 2 trades a week. So you see, it wouldn't work for you. Even if though that strategy or system was correct, your temperament is different. That's why you should never try to mock or mimic someone, because everyone's bringing something different to the table. The beauty of our course is that we present everyone, whether you're a hedge fund trader or a first-time trader, whether you've been trading for a couple of weeks. We give everyone the standard benchmark, all the rules, and then we work with you to mold it to meet your needs. If you like to trade conservatively, we show you what you should focus on. If you like to trade aggressively, we give you the stuff in the course to trade more aggressively. Okay? Remember, you're in charge. Your trading strategy should reflect your persona, not someone you're copying. Okay? I have never traded anything other than FX, but I understand you are showing a strategy that can work on any trade in any market. Yes, it doesn't matter. All of our strategies, all of our techniques, all of our methods, whether it's the PET-D, the trend identifier, or actual strategies, work on any market, any time frame, in any direction. Okay? Question, based on what you do, you apply the 4 quarters. What do you apply the 4 quarters? The start of the next candle or the close from the entry signal candle? Well, it's up to you. That's a good question. They're basically saying, when do you apply? I would personally wait for that setup bar, that required, bar where all the requirements are met, or that signal bar to close. Because you don't, since you're measuring the range, you don't know where that range is exactly going to be until that bar closes. A lot of people would say, but boy, the news came out midday and then I'm going to have to miss it. Well, sure, you may miss it, but oftentimes, how many times have you seen great news come out, you go and buy it, and then by the end of the day, the stock finishes lower, okay? So there's no guarantee with anything. So had you waited for that day to close, then you would measure that range, and that's where you would enter your order, if you wanted to at all. You may decide not to. You may say, boy, I thought that was good news and the stock went down 5 points. I'm so glad I didn't buy it. This is another decision you can make as well. But either way, you're making your decisions. Sometimes the news pushes the market in the direction you expect. Yes, it does. Sometimes it does, but also, trust me, I've been trading for 4 decades. There are many times when it doesn't. I mean, I can't tell you how many times I've seen news come out and people say, well, Steve, I don't understand why you're not buying or why. I said, because I don't base anything off news. And you'll see the stock or the market end up in the opposite direction. And it can be with bad news too. Oftentimes you'll see terrible news and the market will go straight up. So that's why I don't look at news. It's too subjective. Remember, I used to trade on the floor. I was in charge of making markets for roughly 50 stocks. If there was anyone who needed to know the inner workings of their companies, because you're making markets of them, needed to know the earnings, don't you think it would have been the market maker, the person who specialized and made the markets in those stocks? Well, when I was on the floor, I didn't look at any of those things with each individual stock. I didn't know what the earnings were going to be. I didn't care. All I did was listen to the market. The earnings are not the market, okay? What someone is saying, what some investor is saying is not the market. What the institutions are doing is not the market. The market is the chart in front of you. Now, most people say, well, Steve, I don't know how to do that. Well, that's what we do at Specialist Trading. For the first time, with my mentoring and also with the PTS Primo charting platform, you're going to be taught how to listen to the market. That is why we feel most traders fail, and that's also why we believe with our education, you'll become a consistent trader, okay? Let's see, going down here, someone's talked about the Euro-Yen. The Euro-Yen 60-minute is in the head and shoulders and has just broke the neckline, now moving down to W4, then back up to wave 5. Once again, we don't follow any of this stuff. This is a perfect example of how people overcomplicate their trading. Probably one of the most deceptive patterns is a head and shoulder. It's completely discretionary. One trader's head and shoulders is another trader's double bottom. Wave 4, wave 5 is discretionary. One trader's wave 4 is another trader's wave 1. So it's too discretionary. At Specialist Trading, we believe 2 traders should look at the same chart and come up with the same analysis. But how often do you get that with Elliott wave traders or with chart pattern traders? So this is an example of overcomplicating your trading. It is the easiest thing in the world to overcomplicate your trading. It's the most difficult thing in the world to simplify it. But once you do, that's when you get onto that road to consistency, okay? Let's see, is the PET-D an analysis strategy found on most platforms? I use TradeStation. Hi, Ron, that's a good question. Well, we have the add-on for TradeStation where you can use it. Until we had the PTS Primo charts, I was using the PET-D on TradeStation, so it will work with them. But I would suggest, since if you're interested in getting this extremely discounted $37 deal, take a ride with the PTS Primo charts for a while. See how it works. Because we designed it, and I developed it with Pro Trader Strategies, and I think it works much better on that. It's so much easier to apply than on TradeStation. You simply click on that tab, and it's right there. So you'll get a free month, and you can decide for yourself. But yes, we do have it for TradeStation as well. Okay. Okay, as we close here, I hope you all got something out of this. I hope it educated you a little bit. As you can see, we give so much attention to educating you. That is our opinion why most traders fail, because they don't have the standard education to back up their trading. What we teach and what we trade at Specialist Trading are strategies. Why? Well, remember, a system is something that tells you what to buy and what to sell. And in the very first opening statements, I said that goes entirely against our philosophy. We don't want to tell you, it's not our goal to teach you and to force feed you signals. Therefore, we have no track records or anything, because based off what? Everyone trades differently. Based off of trading tick charts, based off of trading one style, based off trading another. There are virtually a million ways to trade our methods, and not one is better than the other. The only thing that's wrong is when you try to mock someone else. So we try to just give you all the standard things that have worked and formulate them to meet your needs. And that is the best strategy for you. So there's no way anyone can have any type of statistics because, once again, based off what? Everyone trades differently. We encourage everyone to trade differently. We don't keep records on all of our members in over 110 countries around the world. You know, they may all have the same strategy, but I assure you they all trade them differently, okay? So basically, signals are based off of entry points. Now, there are, I would say, an average of 8 different ways to enter, okay? So once you get a signal, there's 8 different ways right off the bat you can enter, all right? There's tons of different ways to place your stop. There's tons of different ways to exit. There's just infinitesimal ways to trade. There's no way to keep statistics. And in my opinion, I have, once again, traded for 4 decades. I have taught systems. I've traded systems. I've traded things with statistical numbers where I've gone back 10 years with phenomenal results. And each and every one of them, from my own personal experience, have blown up. In other words, they've lost everything. So that's why I don't believe in them. So I wouldn't want to ever tell anyone, hey, you have to buy one of these strategies. It works 75% of the time. Because that's silly. Maybe it works for me 75%. It may not work for you 75% of the time. So that's why, as you noticed in the very opening statement, we were required to show you a disclaimer, because the majority of systems and things with track records don't hold up. So the law made us put disclaimers on because there's no validity in any type of statistics. Eventually they will blow up, in my opinion. So that's why we're required. If there were strategies or systems that held to their numbers steadfastly, then we wouldn't be required to have a disclaimer. So once again, we're all about educating you. When you educate people, there's no way you can have statistics because everything is different per each player. So come aboard for $37. Trust me, I don't think you can go out to dinner for less than $100 these days for a couple to go out to dinner. This is $37 of 40 years of trading knowledge condensed in a 3-hour video plus 1 month free PTS Primo charts. All of my strategies and everything are condensed in that platform, and we put that together with Pro Trader Strategies. You'll get that free for 1 month, and I can't think of a better way to get started, okay? In conclusion, I want to thank you so much for attending today. I hope you got something out of this. I hope it was able to elevate your trading and open up your view to risk-reward ratio. I want to thank you so much for attending. Remember, contact Pro Trader Strategies. Link, the live link is in the chat box on the far right. That will take you to that $37 deal. That's only going to be going for a couple of days, and then the offer will be rescinded. It goes back to roughly $1,000. So you really want to take advantage of that. All right, thanks again. I look forward to seeing you all as members of the PTS Primo charts and of the Secrets of a Stock Exchange course. Thank you so much. I'll see you next time. Bye-bye.